Alright, so hi guys, hope you've been enjoying the Black Market event, which is now on the 5th day if I'm not wrong, and you've been watching all the different live webinars conducted by myself as well as my team of traders. Hope you watch my video on how I look for the best companies in the world, as well as my recent webinar on how I look for bullish trades in a very unpredictable, bearish market. So to follow up, I created this video today to show you how I look for trades on a daily basis, how I look for momentum, trend continuation, stock trades on a daily basis. So without further ado, let's begin. So as I explained in my live webinar a few days ago, when it comes to momentum trend trading, I only look for stocks with high relative strength. And again, what I do every week is I update the list of high momentum stocks, and this is again posted on my community, the Discord channel, with all our students, right? So again, this week, this is the list of all the high momentum stocks over here. So what I do is I just copy this list. I just copy this list of high momentum stocks and I create a watch list on one of my scanners. So I'm using the TC2000 scanner and I create this high momentum list for the week of 21st November. And again, this week is, or rather this list is updated every single week. And if you miss my webinar, basically what is high relative strength? So relative strength means that I'm looking for stocks that have the strongest price performance relative to the rest of the market. So again, I'm only looking for stocks with a minimum relative strength of at least 85 rating. So again, what does it mean? This means that I only trade stocks that are able to outperform 85% of the other stocks in the market. In other words, I only want to trade the 15% of the strongest stocks in the market in terms of price performance. That's called relative strength. So again, all these stocks on the list I showed you have relative strength 85 and above. Then the next thing I do is then I use my scanner to look for stocks that potentially meet my criteria. So again, this is the scanner I use, which is the breakout scanner, which again, you get all these scripts when you enroll in the course, you get all these scanners, you get the list every single week, and you can scan for stocks like the way I do every single day. So again, all these stocks over here have high relative strength. They are all on very strong uptrends or going into very strong uptrends. So I'm looking for entry points. So again, how do I look for entry points? Recall from my, again, recent live webinar, there are 4 patterns that I'm looking for. And again, if you missed the webinar or you can't recall, let me just do a quick review with you guys here. Okay, there's a bird in the background for some reason, I don't know why. But okay, I live in a very tropical paradise, so that's great. Okay, great. So again, I'm looking for 4 entry points. Now there are 4 ways to enter a high momentum trade, as I mentioned in my recent webinar. You have the trend retracement entry. You have got the breakout from base consolidation entry. You've got the breakout within base entry and the explosive flag breakout entry. So again, very quickly, let me just do a quick explanation for those of you who don't yet know this, right? Okay. So remember that when you look at a stock, okay, I'm looking for 4 types of patterns. Stocks can go into 4 different types of patterns, okay? The first pattern the stock can exhibit is what we call a trending pattern. When the stock is kind of like in a very, very nice trending pattern, like that, right? Makes higher highs and higher lows. So we again call this a trending pattern. So usually in a trending pattern, the stock is bouncing off one of the moving averages in a very predictable fashion. So usually it could be the 50 moving average, for example, okay, or could be the 100 moving average, one of the moving averages. So whenever the stock is in a trending phase, it's like bouncing off this moving average, then it's a no-brainer, right? So it hits the moving average, bounces, 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 bounces. When do we want to buy? We want to buy when it hits the moving average. And of course, we want to see some kind of a candlestick pattern suggesting a continuation of the trend, and we want to buy right there as it continues the trend up. So we buy there and we take profit somewhere there. So this is what we call the trend retracement entry. When it's trending, enter as it retraces to the moving average. So again, here's an example over here, there. So this is a classic example of a trending pattern, okay? So the stock makes this pattern, hits the moving average, goes up, hits the moving average, goes up, so it's in this trending pattern. So again, once you see that, the moment it hits the moving average and you see some kind of reversal, a candlestick pattern, bullish candles coming up, we buy, catch the next wave up, and we take profit somewhere here or take profit somewhere there. Usually I risk, again, 1 hour to make 1.5 or 2 hours. So that's the trend retracement pattern. By the way, before that, recall that whatever pattern we're trading, what are the two rules? Again, number one, we only trade stocks with high relative strength, 85 and above. And the second rule is we only enter when moving averages are in sequence. This is really, really important. The 20 EMA must be above the 40 EMA, and the 50 simple moving average must be above the 150 simple moving average and must be above the 200 simple moving average. So you've got to have this sequence of moving averages, because when you've got this sequence, that means the trend is very, very strong, and there's a very high probability that the price will continue moving up. Again, it's not a 100% prediction, it's a probability, okay, where the odds are in your favor. Okay, so that's the trend retracement entry. Now, what's the second pattern? The second pattern that can be exhibited by the stock is that the stock, after making higher highs and higher lows, it gets tired, okay? So it has to rest. It goes into what we call a base consolidation. So what happens is that the price goes up and then makes a high, okay? It comes down, makes the same high, comes down, makes the same high, comes down. So it hits the same high at least 3 times. 1, 2, 3. You want to see resistance being tested 3 times or more, right? Could be testing 4 times. So whenever it's in this base consolidation, you're waiting for it to break above that consolidation. So you're waiting for the price to break above the consolidation for bullish candle, and then you buy to catch the new trend up. It's kind of like this guy's running, he's resting. Once he gets out of the tent, you jump on for the ride, right? So again, this is what we call a base consolidation pattern. And again, I'm going to show you as I screen the market today how we identify these different patterns. But again, let me show you an example on the charts again. Okay, there we are. This is a breakout from base consolidation entry signal. Okay, so again, starts with a nice uptrend, then hits a resistance there, test 1, hits it again, test 2, hits again, test 3. Again, it has to test 3 times to form a strong resistance, and it comes down, test 4, the 4 tests, and then boom, breaks out. That's a breakout candle. So the moment you get a bullish candle breaking and closing above that resistance, then we can buy the next day to catch the next the trend going up, right? We then take profit at about 2 hours. So that's the breakout from base consolidation entry. So that's a second pattern. Now, what's the third pattern again? You guys recall from my live webinar, I taught you guys. The third pattern is the breakout within base pattern. So this pattern looks like that. First, the price is going up very strongly, and then it goes into a rounded base. You want to see a very rounded base like that? And as it emerges from the base, you want to see the price hitting a certain resistance, a certain high first, pulls back, right? You'll see a pullback. So this would be the high of that pullback. Now, once this breaks above that high with, again, a bullish candle, then we buy as it continues going up, right? So we call this a breakout within base pattern. Breakout within base pattern. So it could be a simple pullback, breaks that pullback, or it could go into a mini consolidation here, and then we buy as it breaks that mini consolidation. So that's the third pattern. Again, let's look at an example on the charts over here. Here we go. This is a breakout within base pattern. Again, starts with a nice uptrend, and then goes into this rounded base, right? Rounded base, hits the high, that's the high of the base, draw a dotted line to represent the resistance, pulls back, and then breaks that resistance. That is the breakout candle. By the next day, if it trends high, if the price goes higher than the close, get in for the rest, right? So again, in all scenarios, remember that before we buy, always check the moving averages have gone back in sequence. In this case, the 20 EMA must be above the 40 EMA, the 50 must be above the 150, 150 above the 200. Moving averages must be in sequence in all four patterns. Okay, what's the last pattern? The last pattern is the explosive breakout pattern. This is one where the stock moves significantly, right? Usually a very strong move, like more than 100% move within about 2 months, and then it goes into a flat consolidation where it's like a downward consolidation like that, right? And it's like like a flag pattern. Once it breaks this flag pattern, you buy as it continues going up. So again, this is called the explosive. Oops. It's called the explosive breakout pattern, and it happens again when you see this kind of like a flag, right? So again, let's look at an example on Z charts over here. Okay, that's the explosive flag breakout pattern. Very strong move, right? And then it goes into this kind of like downward trending flag. It's got to be a downward trending flag like that. Then it breaks that flag on the candlestick, get in the next day if the price exceeds the close of that breakout candle, and then take the trade up. All right, so there's a quick summary of these 4 patterns we're looking for. So with that, let's take a look at today's market. Do we see any of these patterns that we can take a trade? A reminder that all my courses and playbooks are going for up to 75% off during this very limited black market sale, during this black market event. So you can catch all my courses. You can go to piranhaprofits.com, check out all the courses. For example, the options trading mastery package, the price action manipulation package, where you learn how market makers manipulate the markets and how do you trade alongside these bastard manipulators, right? Options mastery package, how do you trade options like a pro? And of course, the stock mastery package, where you learn in depth how I look for high probability trade setups every single day with all our softwares, with all our scanners. As of course, together with our value momentum investing course package as well. So do grab your favorite courses right now. Okay, so today's the 23rd of November, and I just ran my scanner, and you can see these are all the stocks that have come out in my scanner. All right. So again, when I go through all these stocks every day, on certain days I don't find any trade setups. None of them meet the patterns. On certain days you see many trade setups that you could take, and on some days you will also see setups that appeared before that you missed. Okay, so let's just run through these stocks. So I just ran through them a couple of minutes earlier on because I don't want to just waste time going through randomly. But I'm going to point out again some stocks that could be potential trade setups for today. All right. So the first one that I noticed was ENPH. Right. So ENPH, take a look at this chart. Do you see the pattern? Is this a trend retracement pattern? Is this a breakout from base consolidation pattern? Is this a breakout within base pattern? Or is this an explosive flag breakout pattern? Which one? That's right, it's a breakout from base consolidation pattern. It is this pattern that you see over there, all right? Why? Because again, you can see the price, made a high, same high, test 1, test 2, right? Test 3, test 4, and now it's kind of like breaking out, right? It's breaking out of this consolidation with this bullish candle that just closed above the resistance yesterday. So this looks like a valid trade setup. So if I wanted to take this trade, where would I put my buy order? Where would I put my stop loss? Where would I put my profit target? So I'm just going through it with you right now. Okay. So usually what I do is that, okay, I will want to buy if when the market opens today, the price continues going up, right? So if the price drops today, I'm not interested to buy. I want to see the price continuing to go up. So I want to put my buy order right above the close or the high of this candle. So this candle, you can see the close and the high is pretty near. So I'll just put the buy order just above the high of the candle. So I'll use a buy stop limit order above the high of this candle. So what's the high of this candle? The high of this candle, you can see there, is 321.09. So since the $300 stock, high price stock, I'll use about 30 cents. I'll put my buy order 30 cents above the high of this candle, which would be about 321.39. So I'll go to my Excel spreadsheet over here and I'll say, okay, I'm going to put an order in to get into ENPH. It's going to be a long trade. This is a breakout trade. And again, what was the price again? 321.39. Okay, so 321.39. That's my entry price. Okay, let me just make sure the font is stabilized. Okay, great. Next, I have to decide where to put my stop loss. So as I mentioned in my live webinar, I always put my stop loss roughly 1.5 ATRs below the entry price. So ATR stands for average true range, that measures the average volatility of the stock. So currently, what's the ATR right now? The ATR is $18.43. Let me just write this down. All right, so one ATR is $18.43. That means on average, this stock moves $18 a day, the range, right? So I must put my stop loss further than the average range. So to be safe, I put it at 1.5 times the ATR. So what would that give me? Let me see, 18.43 times 1.5 gives me $27.65. So my stop loss would be $27.65 below my entry price. So $27.65, let me punch that in. So 321.39 minus 27.65. So my stop loss would be at 293.74. Boom, there we go. All right. So I'm buying at 321.39. That's my intended entry price. Stop loss 293.74. So my risk per share, my 1 hour distance is 27.65, and my profit target at 1.5 hour would be 362.87. That's my first profit target. Second profit target at 376.69. And let's say if I would enter it today, that would be today on the 23rd of November. Okay. So let me just show you what it looks like on the charts. All right, so you can see on the charts where my buy level, stop loss, and profit target will be. So over here, you can see this green line over here. This represents my intended buy entry. Okay. So again, today when the market opens, if the price continues going up above the high of this candle, it will trigger my buy order at this level, which is about $321. This would be my buy level, 321 point something, right? And my stop loss would be this red line over there. Okay, so after I buy, if it drops and hits my stop loss, I will cut loss on this trade. So my stop loss level would be at about 293. Okay, so the distance from the buy level here to a stop loss, what's this distance called? This distance is called the 1 hour distance. R represents risk. Whenever you take a trade, you must know what is the risk you're taking, your risk per share. So in this case, my risk is 1.5 ATR, which is $27.65 per share. That's the risk per share. So again, if I'm risking $1, I want to make at least $2. All right, you always ensure your risk to reward ratio is in your favor. So even if you're right half the time or less than half the time, you're still going to be profitable over many trades, right? So again, where's my profit target? My profit target will be at 2 hour, which would be about $376. So if I drag the charts out, you can see roughly, there we are. That is my profit target over here. Take profit here at about 376. Again, that's my entry price. That's my stop loss price. So again, let's see what happens when the market opens. If it goes up, it triggers the buy order. So either it will go up to hit my profit target and I get a 2R win, or it hits my stop loss and I lose 1R. Now remember, in trading, the entry and exit rules are only one part of trading. The more important part is your position sizing, how you size your position, the risk you're taking, the risk to reward ratio. Okay, so in this case, how do I size my position? How do I calculate the number of shares to buy? So with that, I use this position sizing calculator that again you get in the stock trading course. Comes with all these wonderful tools to size your positions and so on and so forth, right? Okay, so how many shares do you buy depends on the size of your account. How big is your account? You have $1 million account, a $10,000 account, a $1,000 account, doesn't matter. So let's imagine you've got a $10,000 account in your brokerage, right? So put in $10,000 here or whatever it may be, all right? Next, put in your risk per trade. Now again, always keep it consistent. Could be a 1% risk, could be a 2% risk, could be a 3% risk. I suggest to start with 1%. And if you get more confident, more experience, go up to 2%. I don't suggest 3%, that's too aggressive, right? So let's put in a 1% risk per trade. So if you are risking 1% of your money, that means the most you can lose is $100, right? Your maximum total loss is $100. So how many shares must you buy so that you can only lose $100? Okay, so use this calculator, put in the entry price again. Again, what's our entry price? Our entry price is about, let's see. Okay, entry price 321.39. So let's put that in. Entry price 321.39. Okay, what's our stop loss price? 293.74. There we go. Okay, so put in the entry price, the stop loss price. It'll give you the risk to reward ratio, and you can see you will take profit at 376.69, which is what we checked just now, right? Okay, so the number of shares to buy would be 3.62 shares. Let me say, how do I buy 3.62 shares, right? Actually, you can buy fractional shares, right? But to keep it simple, you could just round it off, right? So you could either buy 3 shares or buy 4 shares. Now, usually when you use this calculator, you very rarely get a fraction, right? You will get normally a whole number. So the reason we get a fraction for this is because it's a very high price stock. It's like a $300 stock, and that's why you get like a fraction thing. But let's keep it simple. Let's say you just buy 4 shares, all right? So if you buy 4 shares, what's the size of your position? Your position size would be 4 shares, right? You buy 4 shares multiplied by your entry price, which is 321.39. Okay, so what is the size of your position? 321.39 times 4 shares. So you're essentially buying $1,285 roughly of the stock. Okay, now question is this: is this your risk? Is your risk $1,285? No, this is not your risk. Right? Your risk is 1% of 10 grand, which is about $100. But in this case, slightly more than 100 because you're rounding up, right? So if this trade hits the stop loss, how much do you lose? Okay, you can see that if it hits your stop loss, you would lose 4 shares, right? And your loss per share is $27.65. Okay. So $27.65 times 4, you lose $110.60, right? Which represents roughly 1% of your capital. So you can see that if it's a losing trade, you lose 1% of your money. So you always want to have that consistent 1% risk. Now, if it's a winning trade, right? It's a winning trade, how much you make, right? Again, your potential profit per share is $55.30. Hitting your 2-hour profit target and multiply by 4 shares, that will be roughly double of this amount, which is about $221.20. There you go, right? So by using this calculator, you are ensuring that, again, you're risking 1% to make 2%. Or in absolute terms, you're risking $110 to make $221. So this is what, again, it looks like on the charts, right? So again, we are buying over here. And again, if it hits a stop loss, we are losing 1%. Hits the profit target, we are gaining 2%. So we're risking 1% to make 2%. Or in absolute terms, you're risking $110 to make $220. Now, some people ask this question, is it possible to lose more than $110? Could I lose more than 1%? Yes. If the stock price gaps down. As you know, stocks could gap down way below your stop loss and you end up losing more than what you intended. So one way to avoid gaps, now you can't avoid it completely. It will happen once in a while, right? But to avoid gaps, never ever trade during the earnings release. Never hold the trade during earnings. Always exit the trade before the stock is going to announce earnings. And if you know the stock's going to announce earnings, never enter a trade just before earnings, because it is during earnings where the stock may tend to gap down or gap up. You don't want to take that risk. Okay. Now, another way to mitigate it is to trade using options. So again, if you use options, you can't lose more than your intended loss, because if you buy, for example, a bull call spread, the most you can lose is the premium that you pay. And again, you could use options to execute the trades as well. So will this definitely be a winning trade? As traders, we never know. All we can do is we can take high probability trade setups, but every trade outcome is random. You never know what's going to happen, right? So this could be a winning trade, this could be a losing trade, you never know. But what you do know is that if you keep taking trades that are statistically giving you an edge in the markets over a sample of trades, after 20, 30, 50, 100 trades, you're going to have more winning trades than losing trades. And your wins are going to make more, your losses are going to make less, and that's how you achieve consistent profits as a trader. So for example, if you take a look at the month of October, for example, I took a total of 20 trades out of the different patterns that I mentioned, right? Some were the breakout from base consolidation, dip on the uptrend, breakout within base. And you can see out of 20 trades, I have had 12 winning trades over here. Now again, not all of them hit the 2-hour target. Some of them I got out earlier because of the earnings coming, or because I saw some signs of exit, which I do cover in depth into the trading course when I do exit early, even before it hits the profit target. So you can see, for example, this was a 2-hour win, 2-hour win again. So what is 2-hour? So I risk 1% of my capital. So 2-hour represents 2% return. Okay. But there are certain trades you can see over here. For example, I only got a 0.8-hour win, right? And a 0.9-hour win. So I got out because of earnings. Before earnings were announced, I got out the day before. This one, I saw a bearish candle on high volume, which is also an exit signal. So these were winning trades as well, but didn't get 2R. And I got like one break-even trade over here. Okay, so sometimes I get a break-even trade because after I enter the trade, once the price moves up by 1 hour, I move my stop loss to the entry price so that I get a risk-free trade. If the price comes back down, I get stopped out my break-even. So this was kind of like break-even trade. So I got 12 wins, 5 losses, and 1 break-even. And this trade, NBIX, I'm still in the trade. It has not hit my profit target yet. So 12 wins out of about 19 closed trades, that's roughly a win rate of about 63%, right? So again, that is realistic in trading. Don't expect a 100% win rate or even a 90% win rate. Yeah, once in a while you could get a 90% win rate or 80% win rate, but not all the time. I would say a long-term win rate average would be between 50 to 60%, right? So if you're getting like a 55%, 60% win rate, that's good enough to be really profitable. And again, you can see the total R in that month would be 14.7 R. So again, what does this mean? Very simple. If you risk 1% of your capital, that's 14% return in a month, right? If you risk 2% of your capital, then multiply by 2, then that's like more than 28% return a month. So if you want to watch me look for more trades today, catch me in part 2 of this video coming up soon. A reminder that all my courses and playbooks are going for up to 75% off during this very limited black market sale, during this black market event. So you can catch all my courses. You can go to piranhaprofits.com, check out all the courses. For example, the options trading mastery package, the price action manipulation package, where you learn how market makers manipulate the markets and how do you trade alongside these bastard manipulators, right? Options mastery package, how do you trade options like a pro? And of course, the stock mastery package, where you learn in depth how I look for high probability trade setups every single day with all our softwares, with all our scanners. As of course, together with our value momentum investing course package as well. So do grab your favorite courses right now.